Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host, for the next 60 minutes as we go around the globe to discuss the issues related to retirement, markets, technology, personal finance, and so much more with members of the media, academia, and financial services. We got another great show for you again this week. Lots of things to discuss. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. Well, let's kick things off with a look at technology. Joining us on the line, he is the Senior Consumer Products and Technology Reporter for The Motley Fool, Mr. Daniel Klein. Hi, Dan. How are you?
I'm good. How are you, Jeffrey?
You know, I'm actually frigid because in the New York area, and I'm very jealous of you being in West Palm. It is about 30 degrees. We've had some snow, we've had some rain. It's sunny, but it is bitter cold with a lot of wind. So I envy you right now, even if it's a gazillion degrees.
It's 78 and sunny, but heading for a Martin Luther King uh, bitter, frigid 65 degrees.
Yeah, well, good. Yeah, I think the audience, those of us in the Northeast who are freezing their rear ends off right now, envy you. So they're like, oh, shucks. So let's jump right in. We're starting off the show with a tech segment. Devin Banerjee from LinkedIn's off this week, so hopefully Devin is enjoying his time off with wife and family. But let's jump right into it. I know you wanted to talk a little bit about a facial recognition ban that's maybe happening in the European Union.
Yeah, so the European Union is looking at the idea of putting a 5-year ban on facial recognition. And facial recognition has been adopted more heavily in Europe than it has in the United States. And it's kind of a mixed bag. So facial recognition, in theory, might spot, the supervillain who's going to blow up the mall and identify him when he's coming into the city and allow police to catch him. But it can also be used in ways that people would find obtrusive.
Mm.
Do you want the library to be able to track where you are because you have an overdue book? Do you want, you have a speeding ticket and they show up someplace to arrest you because you didn't pay it? There's sort of a public line which we haven't really figured out about where this can be used and how it can be used. There's also the question of how good this technology is. So if you happen to look a lot like the bad guy and facial recognition identifies you, a SWAT team shows up at your door and you have to spend the next 48 hours in custody proving you're not someone, that can be a challenge. So this is very useful and helpful technology, but just employing it in public places is a little bit dicey. And I'll give some examples where it works really, really well. We've talked, I travel a lot and I go on a lot of cruises. And when you walk into a cruise on Royal Caribbean at some of the newer terminals in Miami, sometimes they can just use your face to connect you to your passport and you just walk on the ship. And then when you leave, you don't even need to take your passport out of your bag. You stand and look at a screen. It says, yep, that's Dan, that's Jeff, and you can walk right on. I think most people would say that's a good use of facial recognition. What you don't know is that facial recognition also checking you against the FBI's most wanted?
Yeah.
Is it looking at whether you're a tax cheat or other things? I'm not sure, but frankly, since I'm not a criminal, it doesn't bother me. I just want to get on and off the ship faster.
Yeah, and when you describe this, and I have the iPhone 10, which has the ability to recognize my face and opens up the device so that unlocks the device, and the technology seems to work fine. I just don't know what Apple's doing with my picture. Are they doing anything with it? Is that going into a catalog somewhere? Just based on our conversations about data, Dan, I assume, quite frankly, that anything that I provide into a service is somehow being transacted and used. I mean, I just assume that. And
Well,
and I was having I'm sorry, just real quick. I was having a conversation with someone about web apps, and MyFitnessPal is something I use to track my calories and my exercise. Is that information being used? I assume it is, because how can you offer a service for free? You can't. You got to transact. So anyway, sorry to interrupt.
yeah, I think in a lot of cases, that type of information is being used on an aggregate basis, not on an individual basis. Though it might be used in a way to market to you where the company marketing doesn't know who you are, but you're getting an offer.
Mhm.
I have somewhat mixed feelings, but I think this is the direction we're going. we talked about the Consumer Electronics Show last week, and at CES, one of the more common products was locks keyed to your fingerprint and other sort of biometric ways of security, whether that be scanning your iris or putting a fingerprint down. And I think the days of typing a password on anything, and even the days of carrying a key, might be something that goes away because it is a lot more convenient to use your thumb to unlock everything than it is to, carry a big keychain around. I know I have like 30 keys and it's not fun at all. I know that when I pull up to my apartment building, if I'm in my wife's car, which does not need the key in the ignition to turn the car on, I have to dig through my pocket to get my key fob out. It would be pretty awesome if my building could somehow scan my face and know to let me in. That I also might stop people who are loaning their key fobs to friends and
Mm.
illegal renters. So there's a lot of good uses for technology, but I don't think the European Union hitting pause and saying, "Hey, wait a minute, take a look at the rules and regulations." I don't think that's a bad idea.
No, I think you have to think about how data is being used, and we often talk about AI. I mean, I think this all lumps together for me. Call me a layperson, but this kind of lumps together with me with AI and data and privacy. And whenever we discuss these, I walk away thinking about Terminator, the original one, because I like that one the best, and I think about Demolition Man. So I don't know if you're a big movie guy, but you've seen Demolition Man with
Of
Wesley
course.
Snipes, and how they had access to the Warden Smithers, and when Wesley Snipes' character escapes and they actually use his eyeball because they use retina scan. Yeah, you think about bad actors, but I don't think we're at that level. But I think it's good. I think it's a good thing to think about we're going to use data. And quite frankly, in the retirement industry, we're just beginning that effort. We need to think about how people are logging into their accounts, what type of scraping is going on. I know you've talked about that as well on this program and in other venues with us. That's all very important. How is this data being used, and how can we prevent bad actors?
Well, you mentioned AI, and one of the things I saw at, I want to say Money 2020, but I believe one of the many shows I've gone to
Yeah,
recently,
blends
uh, is
together.
I is I met with Intuit, and Intuit talked a lot about how it's using AI inside your account, where you give it some information. Okay, my long-term goal is retirement. My short-term goal is I want to buy a vacation home.
Hmm.
I have this expense. Maybe I have a medical expense coming up. And it can identify which products make the most sense for you using AI. So I think you're going to see very helpful instances of AI in the retirement world. And yeah, I think there is a reason to worry about AI and what we can do with data. There was a Law and Order on last night where one of the criminal or the alleged criminal, because it turned out he wasn't actually committing any crimes, was admitting to having, let's call them unsavory thoughts, and took himself out of situations where he would then act on those actions. So let's call him a murderer who chose not to put himself in murdery situations. Now, that's great on the rare case where someone's that self aware, but what happens when AI can 99% predict, hey, you know what? Jeff is going to do this horrible crime. Can we pre arrest you for a crime you haven't committed and may not commit, but the data says you're probably going to? So there's a lot of sort of dangerous pieces of this where everyone's going to sort of say, well, the greater good is more important. Well, that's great, unless you're the guy in the
Yeah.
tiny percentile who maybe does contemplate doing terrible things, but isn't actually going to do them.
Well, that sounds very minority. Since we're talking about movies, what sounds very Minority Report, right? I mean, that's like I feel like Tom Cruise is going to come down from a skylight, even though that would probably be Mission Impossible. But right, I mean, actually,
Yeah,
they do drop in that movie, right? The whole police force drops in, but it does sound very Minority Reporty. And how do you, as a government or police force or whatever, if someone's premeditating things, how do you deal with that? Right?
yeah.
I
I mean,
mean,
look, there's all sorts of data that could probably predict crime. And if everybody got a full psych evaluation, we could probably give you a score about how likely you would be to say, I don't know, get violent when you've had a few drinks and, commit a felony. The reality is most people probably wouldn't want that. On the other hand, if we said we could identify mass murderers when they're young and treat them and make them not mass murderers and productive citizens, I think people would want that. So we don't know where the line is. And it's like airport security. Where's the line between sort of personal freedom and public safety? We haven't figured it out. And frankly, I don't think we're going to anytime soon.
Yeah, you make me think about the causality loop. I watch Star Trek. I mean, we're hitting on all the genres this on this show. We've always talked about Marvel and Star Wars, but if does something really happen if you prevent it, right? So that's like that causality loop that Jean-Luc Picard in Star Trek: The Next Generation talks about. And if you stop it from happening, would it really happen, Dan? And I think to your point, there's a lot of ethical questions about it, how invasive. And I agree. I mean, if someone's going to arrest you and interrupt your personal liberty, that impacts you. That may not impact the rest of society, but it impacts you. And I think that needs to be taken into account. I think oftentimes, just to get on the soapbox for a second, oftentimes we overlook the value of the person, the individual, and what that means related to the rest of society. I think you've got to balance those things, and that's a hard thing to do in today's environment.
Yeah, it's an old comic book question. If you could time travel, would you kill baby Hitler? Like, there's no easy answer to that because we've seen in every time travel movie or television show that sometimes doing what seems right can cause bigger problems.
Mm-hmm.
It's the entire premise of Legends of Tomorrow, the DC show. They flit around time fixing things, which then causes other issues. So maybe if you kill baby Hitler, something worse comes up in its wake. Or maybe something amazing doesn't get invented because there's no World War II. So there's really all sorts of things to consider that in some ways, maybe interfering with what's going to happen isn't always good for us.
Yeah, I think you're right, and geez, I mean, we just hit every possible genre. We probably need to do a separate show just on these different aspects. I mean, I feel like this is such an important topic and are things that people are thinking about. People are listening to the show, and especially in the context of their money, which both of us are involved in, whether it's the Motley Fool or the Broadcast Retirement Network. These are issues that are going to be wrestled and discussed probably for the next millennium, I would think. I don't think these get resolved in the next 1, 5, 10, or even 20 years. Do you?
Well, next week we're breaking down romantic comedies.
Yeah, yeah, that's
Yeah,
right.
I think the reason these are issues in science fiction is because they're ones we're not going to solve.
Right.
When you look at the sort of basic sci-fi premise of leaving the Earth and colonizing another planet, well, there is a socialistic aspect to moving to another planet. You're only going to take people that bring value to the community. You're going to have to work to pay for your lunch. Robert Heinlein famously says there's no such thing as a free lunch. And you don't have the luxury of certain things when you move into harsher environments. So, as a society, as a globe, we're going to have to figure these things out and we're going to have to decide what the balance is because I do think in our lifetime we will probably see colonization on Mars and other things. And these force issues, the same thing with AI. Like, how much freedom are you willing to give up for safety? When something terrible happens, it's a lot. When you're standing in line somewhere, it's not that much.
Yeah, and that was the debate with the Patriot Act, right, back in around 9/11. And here we are, how many years after that? 18, 19, almost 19 years after that event. We're even more heavily involved in these conversations about personal liberty versus safety
Yeah,
and freedoms.
and I'll bring it back to the airport. Um, I don't believe airport security does all that much to protect us. I think it's largely a show and to sort of discourage things, and that there's probably passive ways where you're just walking through the airport, not standing in a line, not taking your belt off, that right now are cost prohibitive, that would be more effective. And I base this on a couple of things. I've brought things on airplanes, water bottles, containers that are too big. For 2 years, I had a corkscrew in my bag that I forgot someone had given me, and then I got in a lot of not trouble, but sort of like scolded when it got found. And I literally said, "This has been in my bag for 2+ years and like 60 flights." So I think a lot of these things have to get figured out, and the answer is going to be we will give up personal freedom when it's passive. So you can look at me as invasively as you want if I can just walk through the line quickly. If I have to stand in a long line, take my laptop out of the bag and take my belt off, and then you want to look through my bag because I forgot that there was a Red Bull in there. Yes, that happened to me too. And then you're going to give me a lecture. That's not, it's like when you go to the dentist and he tells you to brush your teeth. And the attitude is, you know what? You're the dentist, do your job. You brush my teeth. I'm going to do what I've been doing. So make it easy and people will give up some of their freedom.
Yeah, especially if I produce a lot of calculus in the bottom of my teeth, and so that requires me to go to the dentist on a more frequent basis, but probably the audience and you didn't want to know that. Dan, always a pleasure talking with you. We covered a myriad of topics, and you know what? Dan's going to be leading off our shows next week on the Broadcast Retirement Network. So Dan, looking forward to hearing your perspective on what's happening in tech there as well. Take care, Dan. Have a great long weekend, and we'll see you on Tuesday.
I'll see you then.
Bye. Welcome back, and now we're going to shift gears, talk a little markets. And joining me on the line from Chicago, Illinois, the lead anchor for the TD Ameritrade Network, Oliver Rennick. Hey, Ollie, how are you?
Yo, Jeff. How is it?
It's cold. I know you're headed out east. It's cold here.
I know. I'll be joining you shortly.
Yeah, I know. I'm not excited about this weather. Hey, I want to get into the themes for the week, but I want to just get your reaction to this very well-written article, the title of which is "Man Who Made a Killing During the Financial Crisis Says That at Some Point the Stock Market Will Slow Down." Do you think that's very prolific as a title?
Right? Eventually it's got to, right?
Yeah, I mean,
sounds like
what goes up
sounds
will
like
come.
clickbait to me.
Yeah, I mean, that seems like pretty good logic, but all kidding aside, let's talk about your week covering the financial markets. What themes emerged for you?
Man, it is just wild. Constant gains in U.S. stocks, really just looking invincible to the point where people are obviously waiting for something monumentous to happen to the downside. But it doesn't necessarily have to go down that way. So just to kind of back up a little bit, the stock market obviously continues to rally. We're at all-time highs in just about everything. The exception is we haven't had quite the same degree of strength in small cap, and which is a very domestic index, which has not broken out to a high yet, but it looks like it's on its way. So that being said, the main risk that we have been thinking about here, and that I've been talking about with you in our conversations, is that the market and investors were very much one-sided positioned towards bad events happening. So this has been manifest in very low bond yields and very big bond positioning and big bond flows, and just very consistent, buying of safety assets that, even though they were kind of unwinding since September as some of these geopolitical issues faded, still were really intransigent. Gold then rallied and bonds rallied again on the Iranian flare-up to start the year. Within the stock market, for the most part, this was evident as well as people were generally, up until the last quarter of 2019, more geared towards things that do well in a very low-rate environment, and a low-rate environment being the sort of baseline assumption, given that nobody really thought the economy was going to pick back up. So that's kind of where we have to start, because it's a strange situation where there were actually risks to the possibility of the economy moving too quickly. So in my mind, this was basically the risk of higher bond yields and the risk of sort of positioning that investors in high valuation companies and stuff would get hit if there's a big spike in bond yields. So we saw that in September, but it was a very contained event. Since then, bonds have been just kind of gradually selling off up until this year. So now you've got a lot of these weird cross currents going on, because the last quarter of 2019 was about the economy improving and these early signs of it. And then this year, you still have those signs, but yet people are pricing in a rate cut, as judged by Fed funds futures. And gold is at a 7-year high. Bonds are basically rallying again. So at the same time as the economic picture is definitely improving, you also have this assumption that like the Fed is still going to be active in the market, and they're going to cut rates. Now they're doing the repo stuff, but like that's a big debate right now about what that really means.
Mm-hmm.
But technically, the market is pricing in still an interest rate cut. So you have the economy getting better around the world. It's coming off of depressed levels, but it's still getting better. The U.S. housing market is just absolutely booming,
Yeah.
and yet people are still expecting this rate cut. So now you have this situation where banks and industrial names are actually doing quite well, and those are very cyclically and economically geared. But at the same time, people think that rates are going to stay very low, so they're like piling into these growthy assets as well, and they're piling into bonds and gold still. And so you've just got this like everything rally that's repeating. It's very strange, but to a large extent, the easiest way to basically explain it is we're not in recession yet. Things are looking better, and they're more stable, and geopolitical risks are subsiding. And honestly, you can just take that sentence and forget everything I said before, and that's just pretty much the best explanation.
I mean, I got to imagine that are the opinions on the network. You have a wide range of guests, so I watch the network on a regular basis. You have chief investment officers, you have financial advisors, you have asset managers, you have people who run, different associations. I mean, is there a consensus? I mean, or are there bulls, bears, and people in the middle?
Well, that's what's really interesting is it's very bifurcated, and it shows up in markets, and that's why it sounds like kind of weird that these things are happening at the same time, but you have expressions of economic optimism happening in parts of the market like these cyclical companies which are doing quite well. And for example, semiconductors are about as cyclical as you can get now in an economy that is driven by technology gains, and they just won't stop rallying, okay, because people expect their data to get much better and their earnings to turn the corner after being down for 18 months. But then at the same time, people are buying up gold to the most in 7 years, and they won't sell bonds no matter what, really. I'm looking at bonds right now on Friday, and they're unchanged after the best home starts in 13 years. So you have these two wildly different expressions of what's going to happen to the economy, and one of them is going to win out, right? Either the economy indeed is going to get better, or it's not. And that's pretty much where everybody's casting their vote. So it's kind of strange. But what's important, the last thing I'll say, what's important is in the background, the one thing that's been very consistent, and it really is really just not debatable, is the persistent strength of U.S. consumers, their willingness to spend to the point now that they're buying new homes. And if they're buying new homes, they feel good. And guess what? They're buying stocks too. They're buying Tesla again. They're buying, all this risky, equities again. So.
Yeah, well, I mean that's certainly positive. I mean, consumer sentiment high, and as you said, I mean, my concern is only that the consumer debt. People are buying, and yes, I think housing that's a great thing to buy because you have that's usually someone's biggest asset. But if you're buying just to buy and buying the TV, are you really hurting yourself in the long term? And I will still go back and say, yeah, I will still go back and say that, what is it? What I take away is that what goes up, what must come down, and at some point the market will reverse itself because it just has to happen. And statistically, it's going to happen sooner rather than later.
Possibly, and it seems so, right? Things can't go up forever, but in some ways, like they kind of can in a sense that for example, if you think about well, one, I mean, stocks generally go up over time, but yeah, they correct. Most likely is that when you have these extreme run-ups, then the downtrend is also extreme. And it does seem pretty untenable unless earnings really turn around. But because of what we were discussing before, that investors still have these big positions in hedges and safety assets like bonds and gold, well, if the economic picture actually does pick up, then they're not going to need those as much, and they're going to take that money out. It's going to go somewhere. And it probably will go to stocks in some form, whether it's U.S. or emerging market stocks or, ex-U.S. stocks is a fun conversation to have right now, but it'll probably go to stocks. So in some ways you could see a not too difficult to imagine reason for even more money coming into equities.
Yeah, I guess we could see on the horizon Dow, 30,000, 31,000, who knows where it goes. Well, Oliver.
Hey, we're only 700 points away.
I know.
It's like 2 days.
I mean, in this environment, it is. Well, Oliver, safe travels to you this weekend. Thanks for joining us on the program, and we will watch you on Tuesday, right? You're off on Monday?
That's right.
Okay, so we'll start watching you again on Tuesday. Have a great
Okay.
weekend. Bye.
Thanks, Jeff.
Bye.
Bye.
Welcome back, and we're going to shift gears, talk a little personal finance. Joining us on the line, she's a personal finance reporter with The Motley Fool, Miss Mari Backman. Hi, Mari. How are you?
Doing well. How are you, Jeff?
I'm doing well. I'm trying to adhere to my 2020 New Year's resolutions that I think we talked about on the network a few weeks ago. So far, so good.
All right, great.
Yeah. So I know you wanted to. I mean, I can't even believe we're talking about this, but we're going to talk about taxes. It's only January, middle of January, and we're already starting to talk about taxes. But I know you have a lot of good information to give, so lay it on us.
Yeah, well, I mean, tax season actually doesn't kick off for another few weeks, and taxes, of course, are not due until April 15th. But the IRS actually announced a couple of weeks back that it will start taking returns on January 27th. So if you're expecting a refund this year, it may be a good idea to get your paperwork in order and plan to file on the early side, because the sooner you file your taxes, the sooner you get your money.
Yeah, that sounds like a good rule of thumb. And why give an interest-free loan to the federal government?
Exactly. I mean, the fact of the matter is, when you're getting a refund, you've already given that loan, because it means that you overpaid your taxes the previous year. But exactly. I mean, the thing is, and we've talked about this on previous shows too, a lot of people at this point in the year are still grappling with leftover holiday debt. They haven't really paid off all of their holiday purchases. The gifts that they bought are probably still sitting there in the form of credit card balance. So getting that tax refund money a little bit sooner could be helpful. And these days, if you file your return electronically, which I think a lot of people really are moving toward that, Jeff, because who wants to sit there filing on paper when there's an easier way? If you file electronically, the IRS typically issues your refund within 21 days. So that's pretty good, so you could conceivably get your taxes in at the end of the month and be sitting on a refund by, mid to late February.
Yeah, I mean, timing's everything, and if I can get that money sooner rather than later, I can apply it to, as you mentioned, outstanding credit card balances. And Mari, I got to tell you, I've already started collecting my data that my tax preparer needs. My W-2 and some of my 1099s. I mean, I would imagine that these are things that everyone should probably look to collect soon before giving this. Sorry, I was lost in thought there, but things that we should be gathering in advance.
Yeah, well, I mean, the fact of the matter is your W-2 is a little bit out of your hands until your employer issues it, but it should come in by the end of the month, either by mail or, in some cases, electronically. The same thing with your 1099s. If you've got investments in a brokerage account, if you've got savings in a bank account, you may not get those forms in the mail. You may have to actually log on to your account and access them online, but they should all be available by the end of the month. And that's primarily what you need to file your taxes if you're claiming the standard deduction on your tax return. If you're planning to itemize, you'll need a lot more information than that. You'll need information pertaining to, your mortgage, how much mortgage interest you paid, which your lender will give you that information. You may just need to ask for it. You'll need to figure out how much property tax you paid. If you're claiming a home office deduction, which you can do if you're self-employed and work from home, you'll need to figure out how you're taking that deduction. There's a couple of different options. You can just take sort of like the IRS will give you a standard rate. I think it's $5 per square foot of your office up until a certain level. So you could do that, or you can add up your direct and indirect expenses of having that home office, like your printer paper and your ink, and then indirect expenses like your electric bill and your water bill, because you need all that stuff to maintain that office from home. You could deduct that. If you gave to charity, you need copies of your receipts. If you're taking a medical expense deduction, you need copies of your medical spending. So there's a lot of paperwork to gather, and I think that the sooner you do it, probably the better. If anything, it'll make the process less stressful. If you are, for example, planning to file a little bit later in the year, maybe you're waiting on your tax preparer to give you an appointment. The sooner you get that documentation in order, the less stressed you'll be.
Yeah, and I agree. But there are always a lot of later. I don't want to say later filers. Mari, there's a lot of online tax preparation services. I can think of, I think it's Intuit or Quicken. maybe H&R Block, others have that. I mean, is that a course of action that makes sense if you have simpler tax filing?
Yeah, absolutely. I mean, if you're basically taking the standard deduction, there's really no need to pay anybody. There's no need to pay an actual person to sit there and do your taxes for you. If your income is less than 69,000, or I think it's actually 69,000 and less or
Mm-hmm.
less, you can actually file for free online. You just like type in IRS free file, and it'll take you to a little page where you can navigate how to do your taxes on your own. Yeah, I mean these softwares are pretty much designed to guide you through the whole process, so that even if you're completely clueless on how to file a return, if you have the capability to copy numbers from one form to another, like from your W-2 onto your screen, you're all set. I would say that if your tax situation is a little bit more complicated, it could pay to get a tax preparer. I have one myself, only because my husband and we file, state income taxes in two different states. We own a business. I own a business. So for us, we need that outside help, even though we're both pretty well versed on how to file taxes, and I certainly know a bit about the tax code. But you know how doctors have doctors,
Mm-hmm.
I think even people who advise, in writing on taxes should still have tax help when they need it. But and I will say that if your tax situation has changed from the previous year, maybe now it is a little bit more complex because you do either own a business or you've got side income or whatnot, and you're not exactly sure what you're entitled to claim. It could pay to hire somebody that walk you through the process at least the first year you're in that situation.
I think so. And I think also if, just thinking about making mistakes or an audit, that individual, whomever you hired, the firm, could protect you on the back end if, I've read where the Internal Revenue Service and other agencies have kind of ramped up their auditing capabilities, just to kind of certain things if they raise a flag, not that people are doing something wrong, but it could just raise a flag. Having someone to prepare you, and I know done this in the past, not that I've been flagged for audit, but questions have arisen and I've just passed it over to the individual that I'm paying to answer that question because they prepared the tax return, and also have a relationship with the Internal Revenue Service and the state filing or the state treasury as well.
Yeah, I always say one of the good things about having a tax preparer, exactly, if you are questioned, you'll have that person kind of in your corner who can then look back at your taxes and kind of respond to the IRS on your behalf.
Mm-hmm.
Most of the time it's funny because we hear the word audit and we tend to envision, like you see in the movies, these scary IRS agents showing up at your door, with boxes and magnifying glasses and whatnot. And the majority of the time that's really not what happens. The IRS doesn't have the resources to send agents to regular hold filers' houses to inspect their tax documents. So most of the time you're really just getting a letter from the IRS where either its records don't match what you've reported or you're asked to clarify certain information. And while it's something that you can often do by yourself, having a tax preparer who's already handled your return, you can easily go to that person and say, okay, I got this letter, what do I do? And if anything, it'll just help you avoid panicking a little, I think.
Yeah, I agree. And last but not least, I think there have been some tax changes effective. We talked about, I think, the Secure Act and some of the changes there. They became effective January 1st, but things to keep in mind, the RMD age as an example, the inheriting of IRAs, right? The payout of those inherited IRAs will change in 2020 for the 2020, maybe not the 2019. But all these things, a tax preparer, I mean, all I can say is I would hate to be scrambling around on the last, not that we're not supported by any tax preparation service, but I just tell you from a practical point of view, I'd hate to be scrambling around on April the 15th or whatever the first business day of the week is related to tax day and having to try to figure this out in the last minute. I think you get your documents, you collect them, you think about it, and it gives you time to kind of ponder how best and to file.
Right, and the other thing too is that not everybody gets a refund. Some people end up owing the IRS money, and if you don't pay your tax bill on time, and by that we mean by April 15th, you start to instantly accrue penalties, interest on the amount that goes unpaid. So if you take the time to gather your documentation now, and you gear up to file your tax return in February, you can file and then you don't actually have to pay the IRS until the April 15th deadline. So let's say you knock out your return next month and you realize, oh, shoot, I owe the IRS $900 and I don't have $900 right now. Well, guess what? You've got 2 months to come up with it. You might, I don't know, you might pick up, an extra shift or two at your job, or you might cut back on some other spending, or just figure something out so that you don't end up having to, pay an additional sum on what you owe.
Yeah, I think that's really smart. The earlier you know, the more you have time to put that money aside. And I always stroke that check on the last day possible, because if I owe money, I don't always owe money, but if I owe money, I always make sure that I can wait as long as possible before having that money leave my
Right.
account.
Right, exactly. And yeah, again, filing early does not mean that you have to pay early. The other thing, too, that I like to remind people is that it's actually not too late to fund last year's IRA. If you have an IRA, traditional Roth IRA, you can actually fund the traditional version of it this year, and that contribution goes in tax-free, so that if you do owe the IRS a bit of money, what you can do is put money into that IRA, and that might actually wipe out your tax debt. Because, for example, you put $2,000 into your traditional IRA, that's $2,000 of earnings the IRS can't tax you on. So depending on, your tax rate and whatnot, it may or may not wipe out what you owe the IRS, but it could, it will reduce it. And you have until April 15th to fund last year's account. A lot of people don't know that.
Yeah, come on, people. Do it. Start this week. Start this weekend. I can't think of a better thing to do while you're watching the football games or you're watching Home and Garden Television to see how to improve your home, to sit down and do a little bit of tax. At least get organized, right, Mar?
Yeah, that's what I would say. I mean, that's what I usually try to do. And I'll be honest, Jeff, I don't usually sit down in mid-January to start working on my taxes. I usually give myself till early February just to wait for all of my 1099s to come in, and just to, kind of not be scrambling around for that information. Usually if you give those institutions a little bit of time, they have those documents ready for you. But usually in early February is when I sit down to get everything in order. The reason I don't do it sooner, frankly, is because being self-employed, I don't usually get a refund. If anything, I usually owe a little bit of money, which I plan for and save for. I always have a little bit of extra money in my business account, knowing full well that I probably will have an underpayment on my hands. But I definitely do not wait until April. I don't even wait till March, and I really don't think anyone should.
Yeah, well, good advice. And Maury, really appreciate you coming on. She is the tax. I'm going to call you the tax maven, at least for this episode. She is she's a tax maven, personal finance expert. Maury Backman from the Motley Fool. Maury, have a great weekend, and we'll talk to you again very soon.
Sounds great, Jeff.
Bye-bye.
Bye.
Welcome back. Now we're going to talk a little real estate, and joining me on the line from New York is Market Watch's real estate reporter, Mr. Jacob Passy. Hey, JP, how are you?
Doing well. Yourself?
Little chilly. I don't know if you took a step outside recently, but it is
No,
cold.
I've been in the office since 7:30, 7:45 this morning, so I have avoided the cold for most of the day.
Yeah, you're lucky. It's cold. So, obviously that's not going to change in the near future. I think we're actually supposed to get snow in the area over the next couple of days. But there's a lot going on. Maybe there's some sunshine in the real estate market that you can tell us about. What's going on there?
Yeah, so a report came out today. So every month the Census Bureau puts together a report looking at new home construction, so housing starts, which is, a weird term, but basically just means, construction starting fresh on new homes, and building permits authorizations across the country.
Mm-hmm.
So the report that came out this morning found that housing starts, so new home construction, has soared to a 13-year high.
Wow.
In December. So they track it every month. The data lags a little bit, but basically, it was a major jump from November, and has been. I mean, the pace of new home construction had been increasing through much of last year, latter half of last year especially, but kind of just exploded in December, at least according to the data we have now. Kind of caution being that from time to time this data is revised, so theoretically that figure could change, but kind of a big number.
Yeah, sounds positive. I mean, everything that we have talked about over the last year plus has been, I wouldn't say negative, but there have been concerns in the housing market in terms of, the housing prices have spiked. People have a difficult time getting access to property in certain areas of the country. So I would think, Jacob, this is all signs are positive, even if it was revised down slightly.
Yeah, no, this is definitely a good sign if you're looking to buy a home. Like you were just saying, one of the big issues in the market right now is unaffordability, and the lack of affordability is being driven by the fact that people just can't find homes for sale. There are very few homes for sale, and that drives up the price because of all the competition for those properties. And part of this is all stems back to the recession and the housing market crisis that happened in the late 2000s, early 2010s. We've talked about it before. Home builders, in the wake of the recession, we're building far fewer homes, in part because they had built too many homes before the recession. And so there was this kind of period of time for many years where home building activity had really slowed down. And now it's picking up again, and quite a lot now. And this year, or this, I should say last year, 2019, the latter half of the year when mortgage rates came down certainly helped things, and improved confidence among home builders. And when home builders are confident, they build more. So, and then December kind of had this quirky thing going on where, most analysts say that they think that the reason the number was so high in December was because of the weather. It was a very warm month, historically speaking, comparatively. And, you typically see, all this data is seasonally adjusted to be so they're typically accounting for it's colder in December, so therefore they adjust the numbers higher. The statisticians and the government do, because cold weather, when it's cold, it's harder to get people outside building homes, breaking ground, things like that. But it was unseasonably warm last month, which a lot of people probably remember from the crazy weather we saw during the Christmas holiday, and so that meant that builders could didn't have to slow down construction and could continue doing it in earnest during a month when normally they're dealing with snow and things like that. So I think we're all kind of eyeing a snowstorm in the Northeast this weekend, so don't necessarily expect this to be the case next month. Things will probably revert a little bit more to the normal, but definitely a good sign for folks. One other thing to point out, though, is things are looking great for home builders in a lot of ways, but there are still some significant hurdles that they are facing. One of the biggest ones is actually labor. I'm sure you've talked with other folks about record unemployment the country's been seeing, and that's also been the case in the construction industry. Construction workers are seeing record levels of unemployment, but that's bad news for home builders who need more workers to build homes. They're basically struggling to find people who work in construction and are looking for a job. So because of that, that makes it much more expensive. They have to pay more for their workers, and that trickles down to the consumer. So, it affects the price of the home when it comes to market, but also it means that, there is a large extent to which home builders are still focusing more on the top end of the market, the more expensive homes, rather than the entry level, cheaper homes, because they need to break even. They need to, give themselves somewhat of a cushion so they can, turn a profit. And so that's something to keep in mind is, unemployment's great for the economy in a lot of ways, but, this is one, unintended consequence of it.
Yeah, and just based on, it sounds like the sentiment across the industry, people that you're talking to, real estate agents and people, National Association of Realtors, which I know you talk to on a regular basis, sounds like people are very bullish on housing and the marketplace. Would that be a fair statement?
It depends on who you talk to. There are certainly a lot of people who are very bullish, and I've joked with some of my sources about how the real estate industry, for better or for worse, is super optimistic all the time. It's always a great time to buy a home in their eyes, and they're unlikely to tell you otherwise. But there are certainly folks who are less bullish on the market, and it's in large part because of what we've been talking about just now. There aren't that many homes for sale. People, it's hard for there to be, record-breaking years for the real estate industry when there aren't that many homes being sold. So, and, as long as that continues, people are going to stay on the sidelines because they just can't afford to buy. So, it's until we start seeing, the supply meet the demand a bit more, it's going to be hard for housing to really have, a gangbusters year. But, this doesn't mean that things are bad for the industry. The industry is still certainly going to do well. And, most folks I do speak with say that they think it's going to be positive for, GDP and the national economy. It's just not, going to be, you're not going to see homes flying off the shelves, so to speak, like, we did back in like the 2000s when so many homes were being sold. That's probably a good thing for other reasons.
Yeah, well, they're being sold at high multiples too. So
yeah,
hey,
exactly.
I don't want to take us down a rabbit hole, but just kind of switching gears a little bit. But in line with housing, I was watching YouTube. I love watching YouTube. Some of the features that people come up with and channels, amazing. So there have been many people who, are living in vans and living in converted buses, and I just wanted to get your thoughts about that. I mean, not whether it's good or bad, but just it seems to be even people my age in their mid 40s, thinking that they're going to tour the U.S. and they want to live in an RV. I mean, there's this whole culture that I wasn't even aware existed, and I don't consider myself out of touch at all.
Yeah, no, it's kind of like a sort of almost a subset of, the tiny housing craze, tiny home craze. You know, it's definitely attractive to a lot of people. It can, allow you to travel, see the country a bit more, things like that. I have read, you know, for lack of a better word, kind of funny stories about, and this is something to keep in mind if it appeals to you, if you are living out of your van and your van gets stolen, that means your home has gotten stolen. And that's a thing that's happened to folks. So, I think a lot of this is, driven by, influencers. You said you were watching it on YouTube, so there's certainly, video bloggers who, are talking all about it. And, some of my colleagues here at MarketWatch have done some pretty great reporting in the last couple of years about, this trend because, there's a lot of, unintended things that you're not considering.
Yeah.
It's not actually as cheap as you would think to, convert. You have to buy a lot of specialty parts. You have to, if you're not, a mechanic, you may not want to, go for that because, if your home is on wheels and you don't know how to fix the wheels, then you're stuck. Kind of very basic things like that, and it can be expensive. I think obviously buying a home is probably more expensive than converting a van into a home, but if you're staying at campgrounds, to get the electricity hookups, things like that, those things cost money. You might have to rent, space in a campground or something like that. So it's not like you're just, living free and easy. And then a lot of the folks who, take the approach of, trying to just, sleep in their van or whatever vehicle they're in, in parking lots and things like that. A lot of, stores don't allow that. So then you're, woken up at, 1 in the morning by a manager or a police officer telling you got to move. And certainly lots of trade-offs there, and nothing that I think is affecting the real estate industry quite yet, although, I think, especially when we're facing this affordability issue, I think more and more people are considering at least, maybe not the van life kind of method, but, the tiny home. I think, they're and, manufactured housing, those are, entering more and more in the conversation from, a policy perspective of how can we get more homes available to people who need them.
Yeah, I think it's just interesting, and I think, people trying to live off grid and, whatever floats your boat. I think you just bring up some really important issues and things you need to think about if you want to do that, because it's always, those are edited videos, meaning there's hours and hours and hours and hours of footage that is put together to a 6-minute video. A lot happens
Yeah.
in between getting to the 6 minutes.
Yeah.
So really interesting. But Jacob, always a pleasure talking with you. Really appreciate the insight. Positive news on the housing starts, and we'll look forward to chatting with you again next week to see what else is happening. Hopefully, we both survive the snowstorm here in the
Yes.
east.
Sounds great.
All right,
Talk to
buddy.
you next week.
Bye-bye.
Bye.
Welcome back, and now we're going to finish off the show as we always do with a discussion about all the news in retirement with the Legal Eagles. And joining me on the line from another location, not Washington, D.C., is Kevin Walsh. He's a principal with the employee benefits law firm Groom Law. Kevin, thanks for making time for us today.
Thanks for having us on, and thanks for having me on. I hope you're doing something fun for MLK weekend. It's an important day to remember, an important holiday.
Absolutely. Well, I know it's supposed to. Good thing you're traveling this week because we're supposed to get some snow. It's very bitter cold up here in New York. So hopefully, wherever you may be, it is a little bit warmer.
Well, I'm in Austin, Texas, and I had anticipated it being warmer than it is. It's significantly colder than I'd hoped.
Ooh. Well, I'm sorry, but it can't be any colder than it is here. So let's jump right in. It's been a fast start to January, and you and the team at Groom Law have put together the Secure Act Secure Retirement website. Hopefully, you can correct me if I'm wrong on that. But you just wrote a piece, I think, on annuities with your colleagues at Groom. So I think you wanted to talk about that today.
Yeah, so we've got a great resource at the SecureRetirementAct.com.
There you go.
It just has Groom's resources related to the Secure Act. And yeah, this week I think a great topic is talking about the annuity provisions, because to me, while the pooled employer plans are getting a lot of attention, the changes to RMDs are getting attention, and the stretch IRA provisions are getting a lot of attention, the biggest change is going to be the rise of annuities in defined contribution plans over the next 5 to 10 years. And I say that because the Secure Act makes 3 big changes that increase the likelihood that we'll see annuities inside plans.
Wow.
Yeah, I think it's a big change. So the first, and I think you'd agree this is probably a beneficial thing for retirement savers, is that the Secure Act has a requirement that, when you disclose how much someone has in their account, that you also provide kind of a projection of the amount of lifetime income that account balance is going to be able to buy. And kind of the idea here is that, if you've got $50,000 in your retirement account, you might be thinking, that's a whole lot of money. I could go buy a car. Maybe in a couple of years, it'll be enough for me to buy a boat. But if you're thinking about $50,000 as a lifetime income stream, so as an annuity, $50,000 as a principal, it really doesn't buy that much lifetime income. It's only going to be probably, whatever numbers you want to use here, but it's realistically going to be less than $2,000 a year.
Sure.
So this change of displaying the information in a manner that makes participants think of it as how much lifetime income can I purchase versus, wow, that's a big sum of money, that could increase kind of demand for products that allow people to use their lump sum to purchase lifetime income streams like annuities.
Well, I would agree with you, Kevin. I think this is a great thing to show that information on the statement. I know some providers do, some providers don't, but I think it, to me, as a layperson, not an attorney or a compliance person, seems like a no-brainer.
So one of the big issues that held it back was there was a lot of fear on the part of the people who create these statements that they'd have to come up with the assumptions to use. So there was fear that, if I assume that your amount is going to be able to purchase an annuity paying 5% a year or 3% a year or 10% a year, then maybe I'd have liability in the long run if kind of the annuity payouts changed. But so I agree with you that this is probably a positive development. Kind of the nice thing is that it says, DOL, come out with the projections you want for them to use so that it's really mechanical providing these statements, and there's not as much risk on the service provider or the plan fiduciary that provides these statements. The second big change, and to me this one is equally big because it increases the odds that you'll actually see annuities in plans, is they've provided a safe harbor for plan fiduciaries when they're evaluating annuity products. So kind of one of the big fears has been, well, I'm a plan fiduciary, I'm an investment consultant. How do I evaluate kind of the risk that this giant insurer could somehow fail to meet its promise? So how could I assume that big insurance co could ever possibly go under? Like, what tools do I have? And inevitably, won't I get second guessed after the fact if somehow I manage to pick the insurance company that goes under, because it's such a rare event. Well, kind of the key here is that the Secure Act provided essentially like a list of questions that plan fiduciaries should be asking to evaluate an insurance product, an annuity product. And importantly, they said to plan fiduciaries, if you get answers to these questions, so if the annuity company provides you in writing this disclosure that answers all the questions that we want you to ask, and you get good answers on those, and you use those answers to evaluate and make a prudent decision, then that's enough information to make up your mind. So this safe harbor says, if you get a certain amount of information and you can rely on the information you're given by the insurance company, then if you take that information into account and evaluate it prudently, you reduce your fiduciary risk. And to me, that's going to make it much more likely that fiduciaries will add annuity products, because up until now, it's been kind of an open-ended list of, well, maybe I should have considered this, maybe I should have considered that. The insurance company told me something, but how do I really evaluate if they're telling me the truth?
Yeah.
So this safe harbor makes it more likely you'll see annuities actually added to plan lineups.
Yeah, I think that's smart, and I think it's really hard to do due diligence on these products if you're kind of not a ratings agency specialist or someone who really understands how general accounts function or wrappers and things like that. I think you're right on that. I think it's important to have some guidance around that, and if you collect that information and you will satisfy the safe harbor, that's a good thing.
Yeah, and I think plan fiduciaries, now that they've seen one of these, are likely to ask Congress, when I'm evaluating other products, it might be helpful if we could simplify the decision-making process. So it's a positive even to see a safe harbor like this from a fiduciary governance standpoint. The third thing that we see in the Secure Act that is going to, in my mind, make it easier to offer annuities in plan is they've provided this provision where if your plan stops offering the annuity that you've invested in, you can roll it over to an IRA without it counting as a taxable distribution. And this is a big deal because if you have an annuity on your plan lineup, and you might be worried that 10 years from now they might switch annuity providers, the thing you've been contributing to is no longer available. Up until now, there's been this fear that, well, if I invest in an annuity, I could be hit by a surprise tax, or I could end up surrendering it because my plan fiduciaries might change my options. So there's additional risk for me if I invest in an annuity product. So this is kind of a common sense change, which says, if your plan fiduciary stops offering it, you can roll it out. You can put it in an IRA. So in a way, it makes these annuity options more portable.
Which was a huge issue. That was a huge barrier. In addition to the other things you outlined earlier, the safe harbor, the fiduciary, right? I mean, that was a big barrier in the past.
Yeah. So, taken together, I think by themselves, each of these things might not be enough for me to say that in the next 5-10 years, we'll see more annuities and plans. But when you combine the disclosure, making people think about annuities more, we combine the safe harbor, making it more likely they're available, and the kind of the new portability feature, which makes it, a less risky option inside the plan from a forced distribution standpoint. The three pieces work together in a complementary manner.
Yeah, and I can't believe I'm saying this, Kevin, but you're right. It actually is very practical and makes a lot of sense, which typically, I got to say, no offense to my friends in the federal government and the Department of Labor, but oftentimes, these regulations can be very onerous and not as explicit or not make a lot of sense to the layperson. But to me, it does, and we'll have to see what happens. But retirement income is obviously a big issue in our industry and for retirees, and they need to understand what that money means as they begin to draw it down. So great breakdown. Really appreciate you joining the show today, and wishing you safe travels, a great long weekend, and we'll talk to you again next week.
Thanks, Jeff. Look forward to talking to you next week.
Thanks, bye. Well, that wraps up this episode of the BRN Sunday podcast. I want to thank our contributors And of course, you, the audience, for joining us again this week. I thought today's show was exceptional, and I hope you found it educational and entertaining as well. So until next week, I'm Jeff Snyder, and don't forget, keep on saving and roll with those changes.